Welcome back to Indianomics. We got two contrary signals last week from the global markets. On the one hand, the Fed was telling us that they're worried about global markets and hence fewer rate hikes. But the way in which commodities rallied, it gave the impression that demand probably was not as bad as the markets thought it was. So which side should one lean? What's the view of the global economy going forward? I have with me Manoj Pradhan, the global economist at Morgan Stanley. Thank you very much, Manoj, for joining us on the show. Well, that really is the first question. The first 2 months of 2016, global markets seem to worry about recession. What's your sense of the global economy this year? Is it at least better than last year in terms of GDP growth?
It's a difficult story. I think it's going to move sideways probably at best. I think the downside risks have certainly increased. But my take was that markets were a little too worried about recession risks earlier in the year. What is happening is that the China and the emerging market shock that we've had from 2015 is affecting the advanced economies on the tradable side. So import prices, exports, wherever there's been energy, particularly in the United States, has been a big problem. And that problem is transmitting itself to varying degrees into the local economy. And so there are risks, there are domestic risks, but typically speaking, these risks are not as high as I think markets were anticipating. What we've seen in the recent past is that the data has suggested these stories a little bit more clearly. Where the data has improved, particularly in the United States, I think we've seen the Federal Reserve also acknowledging that, saying that, look, we still want to hike interest rates this year, but not as much as we wanted to. On the other hand, when you look at the euro area economy, inflation over there in the near term has ticked down, core inflation, which is why they're a little bit worried. And if you look at the structural risks in those economies, I think they reflect this differential as well. The risks of secular stagnation in the United States are much lower. They don't have a domestic problem. And in the euro area, that story is mixed. And even from that rationale, the difference between those two central banks, I think, reflects that story.
Okay. Well, I don't know whether to ask you the chicken or the egg question first. Well, let me start with China. Do you see China being less of a dampener on global commodities? Do you think it will be a growth story this year?
I think the commodities picture is very difficult because there are always two sides to it. There's a demand side and there's a supply side. I think clearly what we've seen in the beginning of 2015 and the last part of 2014 was the decline in commodity prices because China's manufacturing sector was going through a growth shock. How the supply responds to that also has a lot to do with it, and frankly, our commodity guys know a lot better than I do on the supply front. But if you look at China itself, I think the China story has also evolved. What we've seen is there's been a dramatic change in the growth mix. And the change in the growth mix implies that the manufacturing sector now is showing incredibly subdued growth and will probably continue to do so for a while. And it's the consumption side of the story that has remained robust in the near term, but over a longer term probably has downside attached to it. So the way China slows down, and it will structurally continue to slow down, has changed. And that has implications for global markets because it's the manufacturing sector in China that matters a lot for the global economy. It matters for trade, it matters for commodity prices, and it just matters for overall sentiment and the way China sees the rest of the world. So to the extent that that story has stabilized, I think what we're working through now is the China shock being transmitted to the advanced economies, as I said, through the tradable sector, through imported inflation. And now the advanced economies are working through how to digest this China shock. It's the second largest economy in the world. Emerging markets are much bigger than they've ever been in the past. It's no surprise that the digestion story is taking so much longer. This is what happens when the second largest economy in the world changes its growth mix.
Okay. Before I come to the developed markets, what about the EMs itself? There was a demand shock or a growth shock for the commodity producing EMs. Is the worst behind them? Would you say that EM, especially commodity EM growth in 2016 will be better than last year?
I think that's a difficult proposition to make. There are two reasons for it. One is we're struggling with low growth, right? Almost everywhere potential output growth has come down. That's true in emerging markets, that's true in the advanced economies. But the problem that commodity exporters are struggling with is a Dutch disease problem. And typically speaking, what happens in a Dutch disease economy is that the commodity sector becomes really strong. It can deal with the currency appreciation. It absorbs a lot of the employment. So the unemployment rate goes down, wages go up, and consumers become very strong. When you have an unwind of the Dutch disease through a decline in the terms of trade, all of those stories start really working themselves backward. Now, what also happens in a Dutch disease problem is, as the commodities and the consumers become stronger, the manufacturing gets weaker because the real exchange rate makes them uncompetitive.
Absolutely.
Now, for the unwind of this Dutch disease, there are two things to keep track of. Number one is that the commodity sector and the consumer first need to slow down. Wages need to decline, the unemployment rate needs to increase, real rates need to come down, the exchange rate needs to come down, and then the manufacturing sector slowly starts getting more competitive. So this happens in two stages. And the second thing to keep in mind is not every commodity producer has the same degree of a shock or the same degree of a problem. For example, Indonesia and South Africa, these are very unique commodity exporters because they export commodities, yes, but they import oil. So they never really got all the upside from commodity increases, and they never saw all the downside from commodity price declines. In other words, they don't really have as severe a Dutch disease problem. So it's understandable that Indonesia's turnaround is faster. Russia has been hit with a bigger shock, so their turnaround has been faster. But most commodity exporters, I think, are still working through, as I mentioned earlier, how to get rid of the supply overhang that remains in their domestic economy.
Have commodities stabilized, or do you think this is just a bear market recovery? And do you think that, given your estimate of global growth, commodities are going to remain depressed?
So our house view is that, look, commodity prices have not necessarily shown a structural shift up. There could be some downside. But, you know, given how much commodity prices have moved and how much China has stabilized over the last few months, it is completely understandable that commodity prices over here look a lot better than they have for the last year and a half. So it's really a conditional argument. And if you look at commodity prices as being kind of stable from here, then you get a little bit of impetus. Even in places like the shale economy, it might get global growth moving a little bit more. So you get some stabilization. If there is further downside to be had, then I think that might be a very difficult proposition for global markets to deal with. What is true, however, is that the commodity shock so far has been big enough for commodity economies to really go through the bulk of that adjustment. When I look at oil exporters having taken their budget prices down from 50 to about 30, and it's happened in a lot of EM economies, it tells me that these economies have finally kind of said, look, this is time for adjustment. I can't really wait for oil prices to come to 60 or 70. I have to treat them as if they're going to be 30 and then let my economy adjust, and we'll see what happens after that.
Okay. Well, finally, tell me your growth numbers for the following economies. For US, for Europe, for India, and China.
So what we're expecting out of each of those economies is a very diverse picture. I think if we start with China, what we're expecting is that the recent stabilization you have seen in China has been pushed through, to a large extent, also through monetary easing and some of the other stimulus measures that we've seen in place. Property sales have been high, car sales have come about. We don't expect that this will be a theme that continues throughout. The second half, in fact, of this year could see a slowdown in China. It's not going to be a dramatic one, but keep in mind from my first point that China is still on a path of a structural slowdown. So whatever you're seeing in terms of near-term stabilization is not going to trump those structural forces. I think the downside to that story will remain in place. Importantly, it happens in a way that doesn't necessarily create a huge demand shock for the rest of the world. It does create demand downside for economies that are plugged into China's consumption. For the US economy, things are a lot more benign. What we're already seeing is a kind of a convergence between the manufacturing and the non-manufacturing PMI. The non-manufacturing PMI has moved down over the last few months, sideways in the last print. The manufacturing PMI has picked up a little bit, and we're seeing some kind of consolidation. The big uncertainty over there is what happens to core inflation. So core inflation has ticked up over the last few months, but there are a lot of idiosyncratic factors in here, and core inflation could move down before picking up again towards the end of the year. In other words, what this implies is that there's enough uncertainty to keep the Fed guessing, and our best bet is they come up with one rate hike in the year.
Okay.
In the euro area, growth has already softened from the robust growth that we saw last year. Core inflation's come down, so it's a less rosy picture. And in India, I think our view has not changed. We continue to see slow and steady progress, which is exactly what we like. We are seeing improvements in the things that are coming out of the current account. The improvement of capital goods is an interesting story. The way the economy is going to grow is through a removal of a lot of the impediments to growth that we've seen for a long time. We are not expecting a robust pickup. We're not really expecting massive dynamic growth. And as I've said to you before in our conversations, it would worry me if India started showing a rapid burst of growth, because those bursts of growth are typically counterproductive over a longer period. What we're seeing, I think, gives me a little bit more confidence that this story can remain in place for a longer period of time.
Okay, that's ditto what Governor Rajan said at the last credit policy meeting. He said 7 to 7.5 is a good rate of growth, almost advising that it would be wrong to chase something that's not too good for the economy. Don't run too fast for your own good, seemed to be the advice. So you seem to be echoing that sentiment. Thank you very much, Manoj Pradhan, for joining us in this conversation. Well, so the key takeaways from our guest is that global growth will not be a lot better than last year. This is good news and bad news. Bad news for exporters, bad news for the manufacturing sector in India. But the good news is also that the commodity prices that have risen are not going to see a runaway rally. That's exactly what we heard from Seth Kleinman as well. So benign commodity prices, even if they have bottomed out, is the picture for 2016. That's it on this edition of Indianomics. Thanks for watching.